Emerging markets promise big growth, but is the reward worth the risk? In this video, we dive into investing in emerging markets. Opportunity or too risky? You'll learn what makes these economies attractive, the hidden challenges investors face, and smart ways to tap into global potential without losing your shirt. Today, we will talk about investing in emerging markets. Opportunity or too risky? So before we get started, make sure to hit that like button, also subscribe to my channel. 1. Emerging markets offer faster growth than developed countries. One of the biggest reasons investors look to emerging markets is growth. These are countries that are developing quickly, like India, Brazil, Vietnam, and Indonesia. Their economies are expanding, populations are increasing, and incomes are rising. That often means more demand for housing, infrastructure, energy, and consumer goods. Companies in these markets are growing faster than those in the US, Europe, or Japan. While developed markets might grow 1 to 3% a year, emerging markets can grow at 5 to 7% or more. That extra growth often leads to higher returns for investors, if they're willing to take the risk that comes with it. 2. Higher risk is part of the package with emerging markets. Emerging markets are not stable like developed countries. Many deal with political changes, inflation, unstable currencies, or weak legal systems. In some cases, governments may interfere with businesses or even nationalize industries. Investors might face rules that limit how much they can own or when they can take profits out of the country. These risks can lead to big losses, even if the company itself is performing well. That's why investing in emerging markets is never just about growth. It's also about accepting the risks that come with economies still figuring out their systems and rules. 3. Currency changes can help or hurt your returns. When you invest in a country like India or Brazil, you're also investing in its currency. If the local currency becomes stronger compared to the dollar, your returns go up. But if the currency falls, it can wipe out any gains from the stock itself. Currency swings in emerging markets can be big and unpredictable. A 10% drop in the local currency can turn a winning investment into a losing one. Investors need to factor this in when choosing where to put their money. It's not just about the business, it's about the value of the money backing it. 4. Diversification is one of the biggest benefits of emerging markets. Adding emerging markets to your portfolio can give you exposure to industries and trends that don't exist in developed countries. For example, while the US might be focused on tech, emerging markets might be booming in areas like agriculture, infrastructure, or low-cost manufacturing. This kind of diversification helps spread your risk. When the US market is down, emerging markets might be up. They don't always move in the same direction at the same time. That makes them a smart addition to a long-term strategy, especially if you want to avoid putting all your eggs in one basket. 5. Demographics are on the side of emerging markets. Many emerging markets have something developed countries don't: young populations. Countries like India, Indonesia, and Nigeria have growing workforces with millions of young people entering the economy. More workers usually means more productivity, more spending, and more demand for products and services. In contrast, many developed countries are aging, with shrinking workforces and more people retiring. This gives emerging markets a natural advantage in the coming decades. They're positioned to grow simply because of who lives there and how fast their populations are developing. 6. Technology is leveling the playing field faster than ever. In the past, it took decades for emerging markets to catch up to developed countries. But today, technology is speeding everything up. With smartphones, mobile banking, e-commerce, and remote education, emerging markets are adopting new tools quickly. Some are even leapfrogging older systems entirely. For example, countries without traditional banks are going straight to mobile finance. This creates new investment opportunities in tech, fintech, and digital infrastructure. It also means companies can scale faster, reach more customers, and become profitable sooner than ever before. 7. Political risk remains a major factor in emerging market investing. Political stability is one of the biggest concerns in emerging markets. Governments can change overnight, bringing new rules, taxes, or economic plans. In some cases, foreign investors face restrictions or even seizure of assets. Elections can cause stock markets to swing wildly. Corruption can lead to scandals that damage entire industries. These risks don't always show up in the numbers, but they were real. That's why smart investors in emerging markets pay attention to news, government policies, and signs of instability. Political risk may not be easy to predict, but it's too big to ignore. 8. Emerging market ETFs make it easier and safer to invest. You don't have to pick individual stocks or companies to get exposure to emerging markets. ETFs focused on these regions allow you to invest in a basket of companies from different countries and industries. This spreads your risk and gives you broad exposure to the sector. Some ETFs focus on one country, like China or India, while others invest across regions, like Asia, Latin America, or Africa. These funds are easier to manage, more transparent, and often have lower fees than actively managed funds. They are a good choice for investors who want access to emerging market growth without picking winners and losers. 9. Timing matters more in emerging markets. Because of the volatility, when you enter or exit emerging markets can make a big difference. These markets go through strong periods of growth, followed by crashes or slowdowns. Buying during a peak often leads to short-term losses, but buying when the market is down, during a currency crisis, political issue, or market panic can lead to big gains over time. Patience is key. Emerging markets require a long-term mindset and the ability to stay calm when prices swing. If you are looking for stability, they might not be right for you. But if you can handle the ups and downs, the rewards can be worth it. 10. The future of global growth is shifting toward emerging markets. In the past, the US and Europe led the global economy. But over the next few decades, that balance is expected to change. Countries like China, India, Indonesia, and Brazil are expected to become larger parts of the global economy. They will drive more of the world's consumption, production, and innovation. As these markets grow, their companies will gain more power and influence. Investors who recognize this shift early can benefit from being ahead of the curve. Emerging markets are not a passing trend, they are a growing part of the global economy, and their role will only become more important. Emerging markets offer some of the most exciting investment opportunities in the world. They bring high growth, powerful trends, and access to the future of global development. But they also come with real risks: currency swings, political instability, and economic shocks. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.